Welcome back, everyone, to VOX Markets. My name is Paul Hill, and I'm delighted this morning to have Rob Ross, Interim CEO and Group CFO for Expediator. That's ticker XBD, a leading Central Eastern European and UK freight forwarding stroke logistics management business. Welcome, Rob.
Thanks, Paul.
Just before we sort of kick off into this morning's positive trading update, can you just briefly give us a real-life example of how Expediator helps its customers? I don't know, take Coke or somebody like that, one of your clients.
Yeah. So I guess the best way to explain it is we can sort out the entire supply chain for a customer. So taking somebody that manufactures something, let's say in Eastern Europe, Romania, for example, we could collect the manufactured product from their warehouse or from their production facility. We could store it in one of our warehouses for them, then call off the product, transport it via road from Romania to the UK, unpack it, put it in one of our warehouses, and then distribute it around the UK. So we can really do that for anybody in any part of the world, from local delivery and collection, transportation to another country, storage, picking and packing, any sort of value-added services, and then distribution in the destination country.
And would you deliver it straight to an RDC for sort of like Tesco's and Sainsbury's, or would you also go down to sort of convenience store level?
Yeah, we can do whatever's required. So through our EMT business, which is hanging garments in the east of London, we do store deliveries there into London or into the rest of the UK. So we can really do anything.
And what are the sort of like Expediator's unique sort of like USPs, differentiators versus the competition?
So I'd say strength in Central and Eastern Europe. So, for example, people with wanting freight into Romania, Bulgaria, Russia, we've got very good quality services there, which will be in our own network. We're also very good from a sort of global freight forwarding perspective, or a Western European freight forwarding service. We've got good technology, which helps our customers, and also very good warehousing in both the UK and in Romania. Also offer hauliers a one-stop shop via our affinity business with fuel cards, or with ferry crossings or whatever. Really a sort of complete supply chain company for our customers.
And so you're an asset light business. You don't actually own the physical asset. So you do all the clever stuff which sits above it and effectively gets the product to the customer in the quickest and cheapest time. Is that the idea?
That is the idea. Doesn't always work like that, but that is the general idea.
And what are the sort of the key growth drivers you're finding in your business? I'm guessing Eastern Europe has got a higher GDP, and but what are the sort of the key growth drivers?
Yeah, so Eastern Europe has got higher GDP growth, as you say, than Western Europe. But lots of e-commerce business. We see a change in our customers. Perhaps they were distributing, so in import services, for example, there's a lot of toys, storage and picking and packing. It used to do larger orders to the likes of Toys R Us, which doesn't sort of exist anymore. So it's much smaller orders. So we're seeing a change to moving towards working with Amazon more and those sorts of e-commerce players. But we're seeing growth across the piece. So sea freight, air freight, road freight, our warehousing. Our business is very strong in Central and Eastern Europe, and we've got lots of good growth opportunities in the UK, and cross-selling between our different businesses. Our earn-out periods have now all finished, so we can really cross-sell properly with our UK businesses, and just lots of good opportunities for revenue growth, both organically and potentially from M&A as well, across the business.
Okay. And then just talking about the sort of trading update this morning, I mean, it does look as though you guys are coming back pretty strongly, quite quickly. I mean, it sounds as though from what you were saying, you've reached sort of like, getting towards pre-COVID levels. Can you just talk us through what you're seeing at the coalface? Because I have a lot of read across for investors in terms of where the economy lies and how it is getting back to work.
Yeah. So if I start from the beginning of the year, January, February, and most of March were as we expected, in line with our budget for the year. Towards the final week of March, quite a sort of steep drop off in certain areas, and that continued into April. Middle of April really flattened out. And then for 3 or 4 weeks, sort of relatively flat at that reduced level. And then since the middle of May, we've seen a steady recovery. I mean, June will be back to pretty much our original budget levels. Most business units are back to pre-COVID levels. So yeah, we're comfortable with that.
And I'm not going to hold you to this because you haven't got any guidance out there. But when you say you're back to pre-budget levels, now, if I was a finance director, which obviously you are, then your budget levels are going to be sort of like, where at least where you were last year in terms of like-for-like growth. Is that the sort of interpretation you're hoping to sort of exit the year at? Or, sometimes I don't want to put any guidance out there, but as in like, you would hope, as long as we don't get a second lockdown.
Yeah, it's difficult to say because we don't know what's really going to happen and what's around the corner. What I would say is we'll be behind in the first half where we were last year, as people would expect. Revenue will be down single digits in terms of year on year, but profitability, you'd normally expect the gross profit to flow through of that reduced revenue all the way to the bottom line. Really, that won't happen. So we'll have better margins, better bottom line margins for the first half of the year this year than we did for the first half last year. It's difficult to know what's going to happen, but in the second half of the year. But we're well placed. We're coming out of the coronavirus period, and I suppose the first half of the year as a better business. So the business that went into this year in January is a better business coming out in June. So we remain pretty positive. Areas that I touched on that were issues in 2019.
Why is Expedia so resilient? I mean, effectively, it's got through this COVID without sort of batting an eye almost. I mean, is it because it's essential deliveries?
We have obviously had areas that have been impacted negatively. I mean, the reason we've been resilient is that we are asset light, so we haven't got a big fleet of trucks or trailers, so we have been able to flex down. Our staff have worked incredibly hard and have been very resilient themselves. So yes, we've had people on furlough. Many of those people have now come back. We've had the temporary pay reductions, which were initially put in for 3 months, but have been we stopped those after 2 months because trading was back to where we sort of wanted it to be. But yeah, just being agile. I mean, freight forwarders generally are pretty agile individuals.
Just moving on to Brexit towards the end of the year. I mean, I would say for a sort of tech-heavy sort of freight forwarder type, that's the expertise. More complexity has got to be good news if you look for optically wise. And so, is that more of an opportunity going forward?
Yeah, well, I think we see it as a net opportunity. We've got 5 companies in the group which have got AEO status. We've got expertise in customs clearance in import services, regional express, and Anglia. We've got the computer systems in place. We've got we're in contact with the trade bodies, and we've had a Brexit committee set up for a number of years. And also, from our perspective, you've only got 20 to 25% of our turnover, which is actually UK European business. A lot of our business is intra-Europe. Or intra-UK. We also do a lot of business where we currently are doing customs clearance. So for us, yes, there's potential challenge to it, but we see that as a net opportunity.
And where would you be sort of like, if I push the clock forward, sort of like 2 to 3, 4, 5 years, etc., where are you hoping to get to in your organic and M&A strategy?
Yeah, so we put out an aspirational target to be a £1 billion turnover business. It's difficult to know where we'd be from a profitability perspective with that. You can target 3-4% as being as a sort of market leading net profit margin in the sectors that we're in. So that's sort of our aspirational target. There's lots of work to do. We know that. But we've got lots of good parts of our business. So from the Palex franchise in Romania to Affinity in Romania to import services in the UK, lots and lots of good businesses with lots of opportunity to develop and grow that profitability. Okay.
I mean, just from an investor perspective, which I am, then I'm not a shareholder of Expedia, but certainly from an investor perspective, then if you hit £1 billion turnover plus a sort of like 3 or 4% EBIT margin. I mean, you haven't got to be rocket scientists to hit sort of that calculates out 30 to 40 million, and your market cap is only 30 million. So you're clearly a very ambitious sort of a management team, and see a good path to that sort of like that objective.
Yeah, we do. I mean, I think I would say this being on the inside, but I think that share price is depressed because 2 profit warnings last year. And not really much good news apart from that we hit a reduced number that we expected to hit last year. So I think the interims announcements are really important. We see today is the start of that sort of good news to the market. We've spent lots of time, lots of effort, and people have worked incredibly hard to get the business on a sort of stable footing. From a sort of balance sheet perspective, our debtor days have come down quite significantly since January. A lot of cash collection is always focus of any business, but particularly during a global crisis, you really need to be on top of that, which we have been. Net cash is at 4.2 million versus 7 million at the year end, but we've paid 3.6 million in deferred consideration. So we believe we're in good shape.
Great. And then sort of like just finally then, the news flow over the next sort of 2, 3, 4 months, etc. You obviously got the outstanding CEO to appoint. What should investors sort of expect over the rest of the year?
So obviously the interim's in September, which I hope people will see as positive. We'll include in that our estimate of the impact of coronavirus. It won't be any sort of add back within our numbers. It'll just be a number that can be added onto that if people want to see, a clear like for like. And then also, as you say, the CEO appointment, and I would hope more strong growth from the business. We're in lots of good markets. We've got lots of good people doing lots of good things. So feeling pretty positive as we go.
And is there any M&A at all? Any additional M&A?
Yeah, no, we're looking at M&A. We've got some opportunities that we continue to look at. So really just as those opportunities come up. So we haven't seen anything. We expected some possible distressed sales. We haven't seen anything. I think there's been sufficient government support for people to get through that. But from our perspective, we continue to look at things, and we've got some exciting opportunities in the pipeline for that.
Brilliant. Well, thanks very much for Rob, for your time, and look forward to hearing how things develop over the next sort of 6 to 12 months.
Thanks, Paul. Good to speak to you.